be experimenting together with inflation, which is generating those higher price in commodity. Having said that, obviously each kind of energy commodity has a slightly different focus. You could see that the oil prices have moved, substantially to above $80 a ton, but I think it was probably more acute in natural gas, where we've seen prices of GKM, the volatility of this, which is the benchmark for natural gas in Asia, moving from, I think it was in March of this year, it was somewhere around $6 to all the way to like $37 or something. So those kind of moves are gigantic for consumers. So obviously they're a lot more difficult to swallow, but they're also justified by slightly different economics. You have, in the oil market, the dynamic is OPEC Plus, which I think has done a very good job to monitor markets. In the natural gas, obviously there's geopolitical, there's more restrained sort of country offering gas, and therefore it's got its own dynamic. Having said all that, so I think in the short term, I think it's more due to kind of the pandemic and us coming out of it. But in the longer term, you have reasonably big challenge for the industry, because if you look at prediction made for oil consumption, if you start, say, in 2050, which is when we're supposed to be at net zero, some people see the consumption of oil will be at 100 million barrels a day. Mm-hmm. And some other people, like the IAS, come out to say we have to be at 20 million barrels a day. That's a pretty wide range of outcome. And that's obviously a challenge for investors to say, am I going to essentially invest in longer-term projects? And if you move it back to 2030, which is sort of around the corner, some people think consumption by 2030 will be up 15 million barrels a day from today. And the IEA say in order to meet the zero target, we have to be down 20 million barrels. So that's again a 35 million barrel a day discrepancy between two potential scenarios in 2030. So that makes it very difficult and challenging for all major companies to make decisions when it comes to investing in upstream.
Yeah, but I mean, let's say it is up, and based on the sort of the current investment levels that we're seeing from the oil and gas industry, I mean, does this mean that, the price spikes we've seen this year are going to happen again? That, this isn't a one-off. We're going to see these things happening repeatedly as we gradually make that shift to sort of renewables.
I think if you think about the response that could come from various places, it can come from OPEC Plus, and they still have some spare capacity to can deploy. Can come from all major companies. They have capacity to increase. Shale production could be increased by 1.5 million a day. And I think that the decision by those major oil companies at the moment is driven more by the fact that their shareholders are insisting on receiving cash dividend. They have access to cash. They distribute it to their shareholder, which is what their shareholders are asking. Other shareholders are asking them to also be prepared for the transition, so they're also trying to respond to that demand. But I don't think there's cash shortages or financing shortages available for developing sort of more oil infrastructure. I think there's more perception that if you want to develop a complicated field, which will take, 3 to 5 years to essentially complete, in 3 to 5 years, we're going to be reasonably close to 2030, and that's going to be difficult to kind of predict what the demand will be by then.
Okay. Well, let's move on from that. I just wanted to touch on your business and the commodity trading industry more generally. I mean, what part do you think, or do you see yourself playing in the energy transition at Mercuria? I mean, how do you see and more widely, how do you see the industry fitting into this? Because it's not clear that renewables, for example, are going to deliver perhaps the profit margins that, oil and gas or sort of metals trading deliver.
Each company will have its own strategy, and obviously I wouldn't want to speak on behalf of the industry, but as far as we're concerned, we feel very, very clearly that we have a moral obligation to get involved very heavily in this transition. So that's not up for questions, and that's not based on return on investments or equity or whatever else. Something needs to be done, but we also believe we're very well placed to actually play a role in that. And why is that? Because we obviously transact over $130 billion commodity a year. So we spend a lot of our clients or counterparty are a big emitter. And also when you move into the renewable space, a lot of those investments can be quite dangerous. The volatility you've seen, for instance, for it's not unfrequent to see negative price for power when a lot of sun is out there, a lot of wind is out there. Sometimes prices go negative. So if you want to make investment in the renewable sector without understanding the components and the risk involved, it's very dangerous. So I think we can help. We can help with this. We've been heavily involved in investments in the US in essentially solar, wind, batteries, and because we feel we have maybe a better understanding of the curve, I think we can have a role to play to help people investing in that sector. But that doesn't stop there. If you look at some of the transport industry, it's going to also need solution, whether it's electric or whether it's renewable natural gas or whether it's biofuel. And we're heavily involved in all these businesses. So we have, I think, the second largest business of renewable natural gas distribution system in the US in a joint venture with Chevron, but we also have investment in the EV vehicles, recharging station. We have other investments in using people's battery at home to store power overnight. And so we're heavily involved in the transportation sector, but it doesn't stop there. We're also involved in the agri sector. A lot of agricultural production is leaving the leftover, the straws can be used actually to create renewable natural gas. So we obviously try to help people. And again, if you don't understand the natural gas price, if you don't understand the commodity prices of various element, power, and so forth, it's tough to make decisions which are safe. So, and obviously that sort of doesn't stop there. I could go on. We have invested in waste management company, which again, it's very important to understand the comparative costs of producing this versus other things. You also have to be, we've built a pretty large presence in the carbon market. That's also very important for people to understand the implication of reducing their emission and what is it they can benefit from, or how can they actually have access to government funding, whether it's in Europe or the US. We also probably one of the very few foreign company looking into the carbon market in China at the moment. I'm trying to help some of the biggest emitter, whether it's in the metal industry or cement industry, with their carbon strategy. So I think there's a big role we can play.
Yeah, and you do have a Chinese shareholder, don't you? So
yes, but that our collaboration in China are mostly with other sort of counterparty there, and then where, as I say, we have a joint venture with the biggest cement producer in the world, and another one about this, the also different industry which kind of are impacted by essentially steel and iron ore and so on and so forth. So,
yeah, I mean, and you mentioned a number of sort of renewable fuels there and alternatives. I mean, what do you think the fuels of the future will be, or will it be a collection of everything from renewable gas to sort of biodiesel to, I don't know, green hydrogen? I mean, do you see them all playing a part, or is there something like sustainable aviation fuel that really sort of leaps out at you?
I think they all will play a part. I think it's impossible to solve the energy transition without having every part of the industry. So I think some people see the future into hydrogen, blue hydrogen, green hydrogen, but that's, in our opinion, going to take a few years before it actually comes to market. It's a very big investment, a logistic chain through ammonia, through shipping, through the whole logistic is quite complicated to put together. But obviously, solar, wind, and the usual sort of renewable will have to play a bigger role. And I think, again, you're going to have to build infrastructure. And I think that's going to take some time. I think people use natural gas as a transition, but the usage of coal is still pretty high. And I think there's no sort of silver bullet in there. Every part of the chain, every industry will have to look into themselves, look into their emission and see how they can solve it. And it's going to be based on eventually on carbon prices. We've seen the carbon price in Europe reaching close to $100 a ton. A lot of people think that if you had a global carbon price of $100 a ton, which I don't think will happen anytime soon, you could probably actually move the entire industries into some kind of lower carbon sort of economy.
And do you have a carbon price that you sort of apply to your investments internally?
Yes, we do, because we somehow, if you look, for instance, at upstream, we've been asking ourselves, shall we invest in the upstream oil industry? And we say, yes, the oil will be around for a very long time. So you have to pass several tests as far as we're concerned. So one of the tests is to say that obviously the investment has to make sense from an economical point of view. So you benchmark yourself at $40 a ton. That's $40 a barrel to say this is where we need to be. And then you have to differentiate the carbon intensity scope 1 and 2 of your crude and say, not all the crude are the same because some of them needs kind of more than others. In the UK, for instance, there's a carbon tax you're paying already. So that's including embedded into your investment cost. In other places, it's not yet. So clearly, that also makes it an important factor in our decision. Another factor we look at, because of our pledge to have 50% of our investment into the transition sector as opposed to the carbon sector, we can't do very large investment in the oil sector unless we do very large investment in the renewable sector. So we're a bit more careful when the big size comes around. We're also mindful of the biodiversity impact on drilling. And, we're trying to also apply a factor amongst the different opportunities we can see.
And just, how do you think about thermal coal? Is that something you're prepared to trade still? It's clear that Asia is going to need this fuel, rightly or wrongly, for, probably another 10, 20 years, possibly. How do you look at that?
It's a good question. We had internal debates whether we should completely get out of it or not. And our opinion at the end is that we're going through a transition and coal is going to be needed for a while. So should we take advantage of this, of the difficulty to fund coal to actually become bigger in that? The answer is probably not. But should we stay in coal to speak to our client and see how we can help them to transition to gas and other form of energy? The answer is yes. So even though coal represents a very small part of our overall mix and business, we think to have a foot in it actually enable us to understand the reality of those markets and enable us to also speak to our client and see how we can help. Clearly, if you look at most of the forecasts for 2030 in terms of trying to keep with the 1.5 or more likely 2 degree, they all assume a very large reduction of coal consumption. And coal consumption, obviously, it's a large part of the energy mix in China, present about 60% of their energy mix. And I don't think that the Chinese are completely in love with coal, but they have some local coal resources. And they also create employment. But I think when you start seeing the heavy coal, is more visible kind of pollution than other type of energy. So when you see in Beijing, heavy smoke coming from factory, when it's very visible, I think it's got more an impact. And I'm sure that if China could, they would rather have a lot more renewable. But these things take time. They also go for nuclear. And the transition, unfortunately, needs to take place. And it means investing in infrastructure. And it's probably going to go slower than we would want to. But I think coal is going to remain a reality for foreseeable futures, absolutely.
Yeah, and that was something that was recognized at COP with the statements that China and India made towards the end of the meeting about them, still playing a role.
So I think they're trying, in my opinion at least, they're trying hard to transit. Maybe we don't feel they're trying hard enough. But in Europe and the US, we benefited from growth from coal industry in the past. So I think everyone has to focus on this and help them to transition faster. Through technology but I can see that taking that very seriously, because most of the counterparty we speak to over there, and it's really the big emitter, they do actually have into their given target by governments a reduction in the intensity of their carbon emission. And they're really trying hard through technology and various means to actually try to be impactful. It's never going to be fast enough, unfortunately. But I don't think that we can say that not enough is being done. They're also going for quite a bit of nuclear sort of production, which again is controversial for some people, but at least from a carbon perspective, is quite neutral.
Yeah. Okay, well, we're running down on time, but just a couple of questions to finish off on. First of all, I just wonder, ESG has become incredibly important for big listed companies. But I wonder, are you feeling the same pressure as a private company to sort of, the banks demanding sort of strict ESG metrics from you now?
Well, the answer is yes, and the answer is no. I mean, everyone wants to have stricter ESG to tick the box, but if you look at the funding curve, when we speak to bank, where we talk about ESG, we're like, okay, we think we're scoring pretty well on ESG, we're scoring pretty well on E and G, and so are you going to give us a better sort of interest rate on our borrowing? And the answer is no. So it's like, okay, so the widest spread I've seen is, I think it was in Italy, it was E&I, when they actually went and literally started splitting their company in renewable or not, and the market is pricing that at 0.0025 basis points. So the market is not recognizing, I mean, the bank are only passing the risk to what the market appetite for. So while the entire world would like to see more ESG, sometimes it's reflected in the equity value of companies, but it's really not reflected in the borrowing cost. And I think central bank and other general institute will have to start installing spreads, because right now the funding curve is very, very similar.
Okay.
For the entire market.
An interesting insight. And so, I mean, my final question then is just something around, commodity markets. I mean, do you think because of the energy transition, we are in a super cycle for commodity prices? I mean, they're going to be higher and stronger for longer.
No, I think they may be, but I think we're in a super volatile cycle more than necessarily a price cycle, because of the difficulty to predict what will happen next. So if you can't predict within 20 million barrels a day demand in 2030, you're going to be in a super cycle for oil. As we've seen, oil has impact, the natural gas price going up meant some consumers started using more oil and more coal. So all those commodities are linked, and all of them have their own sort of reason to have a high level of volatility. The natural gas prices, I was reading yesterday that some people are considering shutting down Nord Stream 1 if Russia invade Ukraine. So all those things, the pandemic, in the last 3 days, we've seen people saying that no vaccine will work and we're going to shut down everything, to everything is fine. So the outcome of everything keeps on being sort of wider and wider, and therefore I think one can expect a high level of volatility.
Okay, and that's how you're sort of setting up your business. You're preparing for that volatility.
Yes, which has a lot of implication on credit spreads, on funding, treasury, margin call, also different things which are going to be, I think, outside the ordinary. We've seen this briefly in the power prices when they literally went from like $10 to like 7,000 in Texas, very briefly during the cold spell. So that's maybe an extreme case, but I think volatility is there to stay.
Okay, well, Will, that's a good place to end things. Marco, I'd like to thank you very much on behalf of the FT for your insights there. We've covered a lot of ground, and yeah, the message to take away is, yes, volatility is probably here to stay. So thank you very much, Marco.
Thank you for having us.
Thank you both. It's great to hear from a chief executive who's really at the centre of commodity markets. And I was very struck by how, despite the broader direction of the energy transition, Marco is grappling with the wide range of forecasts for future oil demand. Is it going to be 10 million barrels per day higher or lower in 2030? No one knows for sure, and that makes it difficult to make a whole range of decisions. Now, as my colleague Jennifer Ablan mentioned yesterday, we like to intersperse the live sessions at the Global Boardroom with highlights from recent FT Live events. So we have a conversation to play you now between our US banking editor Josh Franklin and Goldman Sachs CEO David Solomon, which took place at last week's Global Banking Summit. Of course, we can't take your questions for this one, but you can still air your views on social media using the hashtag FT Global Boardroom. Let's take a look at that now.